morning. How's everybody doing? Let me know if you would, if you can hear me loud and clear. Figure out where the camera's coming in. There we go. Welcome, welcome, welcome. Noon, that's right. It's good afternoon for some of you, huh? Any tornadoes out there? You guys have tornadoes there? I can't remember. Morning, Kevin. Long time. Awesome. Thanks, Lee. Appreciate that. Hello, Helen. Not yet. Yeah. Hopefully they don't come around, but they will eventually, huh? So, well, welcome to Trading Coaches Playbook. We're going to have a little bit of fun, I hope. So, good, Kevin. I appreciate that. That's, we'll touch on a little bit of it today, so you get a little refresher here. So, I hate having to sit and wait for 2 or 2.5 hours, and then you get stopped out. It's really irritating. I'm right on the edge of getting hit on a trade. So it's aggravating. It's like, hey, I was patient. It's supposed to pay off. Yeah, there it goes. That's what I was afraid of. Oh, well. It is what it is. Cancel. It was I had opportunity to make some good cash, but lost a little bit. So no big deal. It is what it is. So here's the disclaimer. I'm not a registered broker-dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading. So good. So here's what's coming up in the next little bit. We got Trading You Live. That is tomorrow. Isn't today the 17th? It is, huh? I often lose track of the date. So, but yeah, tomorrow morning, Trading You Live 2.0. And then Inner Circle, the monthly is the 20th at 8 p.m. Eastern time, and check-in is November 27th at 7 p.m. Eastern time. Mastermind group, the 21st at 8 and the 28th at 8. Hey, Brenda. Vegas Spread Mastery with Sean, November 22nd, 8 p.m. Trading You, November 28th, 8 p.m. That's interesting. I'm going to have to double check my schedule. I could have sworn I was looking at my calendar today, just refreshing my memory. I thought that was on the 30th. I better double check. Maybe we don't do Trading You twice a week, do we? Honestly, I don't know. I just know they asked me when, and I put it on my calendar, and then I go do it. So I thought it was on the 30th. I'll have to go double check that, but I'm doing it towards the end of this month. So Power Hour Monday at noon, and Trading Coaches Playbook, this one every Friday at 9 a.m. or noon Eastern time. Okay, thank you, Lee. Good. Lee just confirmed. And Lee support. That is supposed to be November 30th, not November 28th. So this day right here is actually supposed to be the 30th. Whew. Good. Oh, thanks, Trip. Trip just confirmed that as well. So I'm glad somebody here knows what's going on, because clearly I don't. I don't honestly, I don't get involved in the back end of stuff. I just love coaching and having fun doing this. So I just I try to stay in my lane. I let everybody else take care of that stuff. So not my wheelhouse. But hot cup of coffee. So we're ready to have a little fun. Power Option Plays is Tuesday and Saturday, and then Cover Call Explorer Thursday, E-Mini Think Tank with Brandon Monday, Wednesday, and Thursday, and then Sean's Vegas Spread Mastery Monday, Tuesday, and Friday. So here's what we have coming up in the near future. Of course, you can find us on all the social media spaces. And then if you like me and you like my style, I know some of you already have these, Patterns in a Flash. This is all about technical analysis. It is foundational and advanced. So whether you're brand new or you are further along the path, you will still get a lot of value out of Patterns in a Flash. The Weekly Whispers is once a week. Well, twice a week, actually. Once a week, I do here's all the candidates for the week. And then halfway through the week, I review those and review kind of just the overall what's going on. So you get 2 videos a week. One's usually about an hour. One's about a half hour typically. The update is about a half hour. And the Small Account Big Return is an on-demand class you can get if you're working with a little bit smaller amount. The principles apply. Everything applies, whether it's big or small. And that's one of the things I've said over time, and some of you probably heard me say this, is that it's important to shift your mindset into a place where you think in terms of percentages. Because even if you're working with something small today, and obviously the goal is to grow it to big, right? But if you don't shift your mindset from a static dollar amount to percentages and looking at it from that perspective, then it's going to be hard to transition and move into the bigger numbers if you can get yourself there, right? Because if you start with $5,000, and I know people that have done this, and I've done it myself on a smaller scale, I've done it with a small account myself, right? You take 5,000 to 50 grand and then turn it right back to 5 grand 2 months later. Well, that mental hurdle of, okay, I had $5,000, I was putting $1,000 into each trade. Well, now I'm at 50 grand. And even if you're doing it percentage wise, the same thing, you're putting $10,000 into a trade. Well, if you do that in 3 months, 3 months is not a long period of time, right? You had 5,000 3 months ago. Today you've got 50, and you were putting 1,000 in, which $1,000 in the big scheme of things is not a ton of cash, right? But $10,000 is a different ballgame. That's twice as much as you had 3 months ago, and you're putting that into one trade. It's the same amount percentage wise. But if you can't wrap your brain around the fact that percentage wise it's the exact same, so you should treat the trade the same, do it exactly as you were doing before, and the end result should be the same, right? But a lot of people get stuck in that hurdle. It's 10 grand. That's a lot, right? Versus 1,000 is not a lot. Does that make sense? Hopefully it does. So you just got to shift your mindset into thinking in terms of the percentages, because eventually when you get there, that's where you need to be, right? But get back to some basics today, ABCs, but then we're just going to go to C, and then we're going to turn back to A. Because the reality is that trading is not really that complicated. I know it seems like it, especially if you're new and you're just getting started, right? There's the old adage of drinking from a fire hydrant, and that's what it feels like. But once you kind of you gather the information as much as you can, and when you start to break it down and really make it simple, there's not a whole lot to it, really. And I've come full circle. Because when I started back in 2000, it was like that, right? It's just everything's coming at you. You got technical analysis, you got options, you got strategies, you've got this, you got a million things coming at you. And you listen to the guys on CNBC and you think they actually know what they're talking about. And then you realize at some point later that they're just reporters and they really don't know that much. And they'll have different ways to do it. And there's just so much information, right? It's overwhelming. So once you kind of start to put it together and you get off in the weeds and you start doing this crazy stuff and you try to draw your own charts and try to create your own indicators, and yep, that's what I did. It's crazy. You come full circle and realize that it's really not that complicated. And that's really kind of the core of how I coach, is coming back and keeping it simple, getting back to the core basics, right? And it's a story I've told many times back in, I think it was my sophomore, junior year of high school playing basketball. We were playing a team that was one of the worst in the league, and we were one of the best in the league, and we were just smoking them. We're up like 30 points. And all of a sudden they catch up in a matter of a few minutes because we're out there goofing around because we know that they're not good and we know that we are good. And we lose like 20 points to them. We're only up by 10 now. We lost a 30-point lead, went to 10 points. Coach was hot. Calls a timeout and he calls us in like, what are you guys doing? We all want to be like Mike, right? And we're all trying to be fancy and cool. And he just goes off on us. Like, what are you doing? The guys get back to the basics. Stop doing all this fancy stuff. You're not Michael Jordan. Okay. Just go out there and play, execute the plan, and play with the basics. And I don't know why it sticks with me. It always has. But yeah, he was mad. And then we went out and we ended up just smoking him the rest of the game. So, but that's where I got to with trading. You know, I had to go out and try all that fancy stuff to find out that it really doesn't work. It looks good and flashy, but it really doesn't do anything for you. So, can't see her. She's right there, Brenda. Right there. She's hanging out up there. She got up there before we even got started. So, which is good. Hopefully she'll stay up there, but she won't. She'll eventually get too hot and she'll come down and probably lay here, probably on my hand where the mouse is, where I'm trying to work, which is what she likes to do for whatever reason. So if we break this into just 4 steps, right? The first one is analysis, which is usually the big question, especially if you're newer and you're getting started. Like, where do I find my candidates? How do I find candidates? And a lot of that's going to depend on what style you choose to trade, how you are going to trade, right? There's lots of different ways. There's millions of different ways to do this as a business. So one of the key things is you've got to figure out yourself, personality-wise, what are you? What type of trading do you want to do? Do you want something that's a little slower, a little more methodical, a little more risk-averse, if you will? Do you want something that's, is like Mach 4 with your hair on fire? I mean, that's kind of where I'm at. Maybe someday I'll slow down and not be as crazy, but right now I'm having fun and it's a good time. So why would I stop? Right. So you got to figure out where you want to go. You know, if you want a slower, less wild and crazy ride, then maybe you do non-directional strategies. Maybe you're doing covered calls. Maybe you're doing spreads. There's a lot of different ways to go, right? So that's the first thing you got to figure out is where do you want to go. But then you've got to take your whatever style of trading you like to do. You've got to figure out a way to analyze and figure out where to get in, where to get out, right? Step two is, what is your belief? What do you believe is going to happen based on your analysis? Okay, here's the chart. Here's my fundamentals. Here's whatever method you're using. Okay, we'll get deeper into these, but then you come up with a belief, right? You do the analysis. This is what I believe is going to happen. Then you have to make a choice. What am I going to do with the analysis and the belief? There you go. I figured she'd come try to get my water. No, you stay over there. I knew it. I told you. So you do your analysis, you got your belief, and you got to make a choice. What am I going to do? And then, so there's the ABCs, right? And then we go back to A, and now you have to take action. And what does that action look like? So let's dig into each of these individually. And then if we have time, which I think we will, we should, we'll go spend a little time on some charts. So where do you find your candidates? Where do you find them and how do you analyze them, right? Well, you can just throw darts at a paper, right? Does anybody still get the paper? I was just thinking this morning about that. Back in 2001, it was. I used to get up at 4 a.m. because the market opens out here at 6:30, right? I used to get up at 4 a.m., go to the gym, and then stop on my way home. There's about 3 different places in the whole Seattle area that had Barons. And there happened to be one of them at the post office on my route home. So I'd stop every day. It was a quarter, right? So I always had quarters in my truck, and I'd throw a quarter in there, grab a Barons, and go home and sit and read the paper before the market opened. But I mean, you don't have to go anywhere now, right? You just do it online. But I don't even do that anymore. I stopped doing that because it really wasn't benefiting me at all. You can list to family, friends, coworkers, right? You can all gather around the water cooler and, hey, what are you trading? What are you trading? That's typically not very effective. You can watch CNBC, right? You can watch those reporters tell you all about what they don't know. And, some of them know some, but for the most part, they're reporters. You got to take with a grain of salt what you're listening to on there. I don't have it on very often. I do sometimes now, just for entertainment. Then eventually it works on my brain. It's like, whatever. And that's the thing you got to be careful of is listening to other people. And I remember it was back in 2001. I remember it was in Vegas, actually down doing some prop trading down at this firm. And I was still doing some of my swing trading, and I had to trade on Intel. I think I had calls on them. And I was underwater. I didn't stop out like I was supposed to. I didn't follow my rules. Right. I only trade for a little over a year. I still break my rules sometimes. It's like, oops. I mean, we're human. We're always going to make mistakes. But I remember some kind of news came out that sounded good. Okay. I'm upside down. I didn't stop out. I was basically, my strategy at that point was hope. And there was some news that came out on CNBC about Intel. I was like, oh, sweet. And I heard it. And I was like, that's going to make my stock go up. Didn't do anything. Did absolutely nothing. So you got to be careful. And that's basically confirmation bias, right? We have all these biases, psychological biases that we all succumb to at some point or another, and in one way or another. And first, you got to learn to recognize it, that you're doing it. And then you got to counteract it and fight against it, right? It's human nature to go find the information that confirms what we already believe. We don't necessarily go out actively and look for something to tell us that we're wrong, okay? Because we don't naturally like to be wrong. As traders, hopefully you've learned to accept that you're going to be wrong. You're going to be wrong a lot, probably more often than you're right. And that's not bad. It's perfectly fine. Actually, it's common. But you got to be careful of what you listen to and how it affects you, how it affects your psyche, right? The last two are the main ways that thought I turned that off. Let me just set me do this so I don't get this thing. It's usually pretty quiet, but who knows? So fundamental analysis and technical analysis, these are the two main things that people are using, right? Fundamentals, for the most part, is if you're doing long-term buy and hold type of stuff, fundamentals can be good for that. I don't use it. I mean, I understand some basics about it, but I really don't. Because I'm not buying and holding, right? I'm a short-term trader. I want in and out I want to be in cash as much as possible and in and out as quick as possible. So fundamentals, and part of the reason I don't like them, and they do work for, like I said, long-term. If you're buying and hold, if you're looking for a value stock, there's nothing wrong with them. But the issue I have with them is you're bringing objective data into a subjective marketplace. And I don't see the sense in that, because the market is not based on fundamentals. It's not based on news. People say, oh, market moves on news. News moves the market, or earnings moves the market. That's only partially true. Emotions move the market. It's people's emotional reaction to the news. It's their emotional reaction to the earnings that drives the market. The market is an emotional place. And if you haven't traded with funded money yet, then maybe you don't know that. But if you've put money into a trade, if you've put any money on the line ever, then you should understand very well that the market is an emotional place, because once you risk your own money, it gets emotional. And one of the critical pieces to learn with regard to trading is how to manage that. That's what we talked about last night in the Patterns of Flash class. We do once a quarter for those that subscribe to Patterns of Flash. We do a live class. Same thing with Weekly Whispers. If you subscribe to either one of those, you get a quarterly class where it's live. We do whatever we want. We talked a lot last night. We went real deep into mindset and what differentiates pros from rookies, or pros from non-pros, I should say. So, but fundamentals, they don't make sense to me, especially on a short-term basis. Technical, though, is where it's at, in my opinion. Even if you're going to trade a little bit longer term, and long term for me is like a year, and I don't even have that many of those. I got 3 or 4 different trades that are longer term. I've been in it for a year and a half. And that's even longer than I thought I'd be in. I expected to be in them about a year is all, but they're still doing okay. So I'm not worried about it. And they're not big positions. So I don't have a lot of risk on the line. So I'm not worried, but technical analysis is where we can see the emotions of the market, if you will, the picture that you look at. And when you learn and understand how to analyze the charts, essentially what it is a visual representation of how traders are feeling. That's all it is. And all you've got to do is learn to see and understand and recognize how they're feeling. And then you can go from there. Then you can go to B, right? Once you've done your analysis, where do you believe the stock might go? Keyword there being might. You've got to, speaking of mindset, you got to be cautious not to let your ego, we all have egos, right? Some bigger than others, but it's there, and we don't like to be wrong. And so we will fight against being wrong all day long. So I think one of the most important things to do when you're developing your belief is to understand that you might be wrong. You probably will be wrong. Actually, the odds are in favor of you being wrong more than you're right. And that's perfectly fine, because we can compensate for that with risk reward. In fact, you should be wrong more than you're right. I'm at like, I think 40% or so as far as accuracy, as far as, winning trades versus losing trades. But I'm up a bunch because I don't need to be right a lot. Right? It's like baseball. I use that a lot. Baseball players are hitting, 260, 280. They're getting a base hit 26, 28% of the time. And they make 7 figures for doing it. So you don't have to get base hits every single time at bat. You're not going to get a home run very often. It'd be nice to get a home run every single at bat, right? If you step into the box and every single time hit a home run, boom. It's not reality. It's never going to happen, right? But you got to decide, what do you believe? Is it going to go up, down, or sideways, do you think? And then if you're trading options, which I'm assuming you probably all are, we have to add one more piece into the analysis picture, right? Because options have a limited time frame. So you have to decide how long might it take you to get to where you're going. So if you're just buying stock or shorting stock and you can hold it as long as you want, then the time factor isn't that critical. But again, when you're trading options, or if you're trading futures or whatever you're trading, if there's a time component to it, you've got to add that piece to your analysis. And like I said, most of you are probably trading options. Some people are freaked out by options, but which to me is, I don't want to sound like a jerk, but it's ignorant. Okay. Everybody goes to the grocery store, right? Some of you are probably going to go this weekend and stock up for Turkey Day, right? You're going to probably buy milk. I know I'm going to get some heavy cream, some sour cream. I've got a few things on my list I got to get. They all have expiration dates, right? So all you do is plan for it. You go buy it the week of or a few days before you're going to use it, and then you use it all, or you use it up quickly. You use it before it expires and goes bad. That's all options are. They have an expiration date. The beauty is that you get to choose your expiration date, just like you kind of can at the store, right? There are some things that have maybe a longer expiration by a little bit. Milk there might be one that has 3 days more. Well, if you can take that one versus the one that expires quickly, why not, right? It's the same price. Of course, in options, it's more expensive. You're going to pay more for more time. But that's the beauty of it. So that's part of your analysis that you have to come with to your belief, right? So now we're on a B. The third one is based on your belief, what choice do you make? Are you going to buy the stock? You're going to go long, short the stock? You're going to buy or short an option? Pick a non-directional type of strategy. I mean, if you think it's going sideways, non-directional would make the most sense. If you think it's going to move big, then a directional strategy makes the most sense. That's why I think I'm not of the opinion that you pigeonhole yourself into one or the other. I think if you're starting, if you're new, you pick one and master it. But I think it's good to have a directional strategy and a non-directional strategy, because sometimes the market is just stuck in a range and it's not going anywhere. And then you can utilize a non-directional strategy to take advantage of that, right? Instead of just sitting on the sidelines and doing nothing, which isn't a bad thing, right? Because notice that's the last one. Sometimes the best trade is no trade. Sometimes it's better to be on the sidelines instead of in the game and just watching, right? Because I'd rather be sitting on the sidelines, sitting outside the ring, than be inside the ring and getting beat up. So however you want to put it, but step 4 is action. And these are 2 questions. I don't know if I've ever asked them like this, but the one thing I talk about quite often is odds. This is a business about odds. Just like the baseball player, right? At the beginning of the season, he knows that he's got 500 or 600 at-bats coming up. Right? You got, 150, 175 games in a season? About 4 at-bats on average per game. So 4 times 160 is 640 or something like that? Just call it 500. If you know you have 500 at-bats and you're going to get 3 or 4 a day, every single game, if you go up to the bat, you step in the box, you strike out. Okay, not that big of a deal. I got 499 more to go. I don't need to hit a home run on my first at bat. Next at bat, you walk. Yeah, it doesn't help my batting average, but it's okay. I'm on base. I didn't strike out at least, right? So you're on base at least, right? The next at bat, you strike out again. It's like, and your 4th at bat for the game, you hit a base hit. You're 1 for 4, right? Or do they count the walks? I don't remember how they do that. Is it count? Is a walk? Walk's not counted as an at bat, is it? I forgot all about that stuff. I used to know that stuff when I was a kid. I barely even watch it anymore. I enjoy watching it. It's just not a high priority. I'm not going to take time out of my life to sit and watch baseball. I don't mind going to a game now and then, but I watched quite a bit this year, actually, relatively speaking, because my neighbor blew out his tricep and he had to have surgery. And so he wasn't working and he just sit and watch the TV. He's bored out of his mind. So he'd send me a text, the baseball game's on. Hey, baseball game's on. I got some beer over here. Come over, hang out. His wife was working or something like that. And so we did that a few times. I just couldn't remember if they count, if a walk is considered an at-bat. But either way, okay, so let's just say you're 1 for 4. Okay, you're 1 for 4. You're still 25%. And that's a decent batting average, actually. And in the market and risk reward, okay, for those of you who know me, know that all you have to do is be 25% or better. And you're okay in trading. In fact, I think, how much time we have? Oh, yeah, we have plenty of time. I'm going to do that real quick. And then scaling. Scaling's a huge, huge thing. And the main thing that we've got to do as traders is you've got to learn to manage your mind. And those 2 things, number 1, risk reward. When you realize that, okay, I have 500 at bats this year. I don't need a hit on every single one. If I can get 125 or 150 base hits a year, I'm good. I'm going to stay in the big leagues. Scaling is another thing that will dramatically help you manage your mindset. where you get in or out of trades in chunks, right? Because sometimes you look at something and you get nervous, or you get fearful, or whatever the case is, your emotions are riding high and you're not sure if you want to pull the trigger, right? Some of you have probably experienced this. You've been like, I don't know, should I or shouldn't I? And you sit there hem and haw and you're like, I don't know. And you can't decide. And I know when I started, which it was a different ballgame back in 2000, because commissions were expensive, right? When I started trading in late 2001. I started learning in April of 2000. It was, I think, October, because I was young and dumb, 24. I was pretty much broke. I didn't have any excess cash sitting around. I scrounged up some money. I saved some cash, started trading. I think it was October. And the cheapest commission I could find was $75. That was up to 10 contracts, which I only had $1,000. And so, I was paying $75, not 75 cents. Today it's 75 cents. If that's, I don't even know what it is. I don't even look at it because it's so minuscule. But when you're paying $75 per trade, it's a whole different ballgame, right? And it was, most of the coaches I had were paying 150 to 300. And we would shop around. You'd shop around for commissions because they were a big factor. Today, they're not. I see people shop around. Well, what are you paying? 75 cents? No, I'm paying 85. What do you do? I mean, if you're talking thousands or tens of thousands or hundreds of thousands of dollars, that's pennies, right? But today it's so small that scaling is feasible. It's very easy to do, even with a smaller account. Even if you start with $1,000, it's easy to scale in and scale out. You can pick up one contract and two contracts and three. But there's the thing is the main thing is to learn to manage your emotions in a way that when you do pull the trigger, you're comfortable doing it. You're calm, cool, and collected, right? When you watch the baseball player, the pros go up to the bat. They're not freaking out. They're not stressed out. They're not sweating, right? They just walk up. They're just doing their job. They've looked around and go, what inning is it? Here's the outs. Here's the bases. Here's what it is. Here's the situation. Here's the pitcher. Here's what he throws. He's a slider guy. This is probably the pitch that's coming. I'm going to be prepared for that. But, right, so there's the belief, right? You analyze the situation. I believe I'm going to get a slider. And then you're prepared for a slider, but then you have to be able to adapt in a split second on your belief. As a baseball player, you're standing there at the plate, and all of a sudden it comes in with a curveball. You're like, oh, switch it up, swing. Maybe you hit, maybe you don't. But when they strike out, they don't freak out, right? I mean, occasionally, right? The hothead guys, they pound their bat, or maybe it's an important game or something like that, so the emotions are riding high. Or maybe they get a bad call from the ump and they freak out and start screaming at the ump, right? But for the most part, 99.9% of the time, they're just calm, cool, and collected. They walk up to the plate, they get a hit, they don't get a hit, they walk back to the dugout. They're just doing their job, right? They're calm, cool, and collected. And they only get fired up once in a while. And that's where we need to be with trading is, first of all, recognize it's a long-term game. You're gonna strike out. You're gonna get base hits, doubles, occasionally get a home run. And if you look at it from that perspective, if you get your mindset into that place, because it's really easy, and so many of us do this, and I'm guilty of it too. I always teach from pure experience. So if I say this is what you may be doing, or you might do it, I've done it. Pretty much all of it is that we get so focused and so intensely concerned about one individual trade that we lose sight of the bigger picture. So we got to remember to step back and recognize and realize that we've got, dozens, if not hundreds, if not thousands of opportunities every single year, every season, if you will, to place trades. And the risk reward component is a huge one. And scaling is another one that, again, it's one of those things that you use to manage your emotions so that if you are fearful, because, that's what I was getting at, is when I started, everybody did 10 contracts. It's all 10, a 10 in and 10 out. You go buy 10 contracts, you sell all 10. Scaling is where you get in maybe, one or two or three, and you add to it. Well, scaling out is what most people know, right? You buy 10 contracts, then you get rid of 3 of them. If it moves in your direction, you take profit on 3 of them, which not only banks a little bit of profit, but it reduces your risk, right? You take risk off the table. Now you've dramatically increased your odds of being profitable, even if it backs up against you, even if it turns around and goes the other way. So you take profits in chunks as it moves in your direction. Scaling in is the opposite, where you buy in chunks, and if it's moving in your direction, you add to it. That's harder mentally to get into. I know, I can't remember who was it. I think it was Jennifer. Said something, she's not here. somebody was saying that a month or two ago, we were in a class. It's just hard to wrap my brain around that, because what you get stuck on is, I just paid $3 for that option and now it's at 350. I should have just bought more at 3. Why did I do that? Well, if you buy a little bit at 3 because you're not certain, you have less risk, right? You get in, the stop is closer. It's not going to hurt as bad if it goes against you. And then it moves in your favor. Now you add to it at 350. Your cost basis, if you're doing equal amounts, is 3.25. Well, it's trading at 350. And your cost basis is 3.25. So you still have a little cushion there. So even if it backs up a little bit, you can still get out break even. Or if it backs up to your stop, your stop's not going to be quite as big because you had less invested in the first section, right? So you've got less risk, but then you've added more leverage so that if it moves, it continues to move in your direction. Now you've got the opportunity to make more profit as it continues to move. Hopefully that makes sense. If you haven't done scaling in, then just start doing it and you'll see. But the last question is the most important. I'm going to show you the risk reward thing and why it's so critical. Is how do you structure the trade to maintain a calm, cool, collected demeanor? Number one, you want to put the odds on your side, which is actually really simple. It's just simple risk reward. But then how do you set it up so that you can stay emotionally intact, if you will? Calm, cool, collected, where you're not freaking out. You're not sitting on edge. Your knee's not dancing on the floor by itself, jumping around, right? Your hand's not all sweaty and you're freaking out. Because I've been there. I mean, we all have, right? If you've done that. And if you realize you're in that place, if you're in a trade that you're getting nervous and freaking out about and you can't sleep, then you've got too much leverage. Okay. You're over leveraged and you've got too much risk for where you're at mentally and emotionally. Every day. Every day. Well, all right, Brenda, I'm not. Okay, that's a different issue then. Man. Okay. Well, Brenda says that's me every day, even with one contract. I think what you probably need to do is step back and going back to what I was saying is recognize that, you know, it's a long season. You got 250 games a year. Basically, there's 245 trading days a year or something like that. Right. So if you want to, however you want to break it down, is you've got this big picture, right? You got 250 games in the year. And if you have one at bat every day, or even one at bat, you got 52 weeks a year, right? You take one at bat per week. You got 52 at bats. If you're doing one contract trade on every single one of them, and if you lose $1 on, say, 30 of them, you've lost $30. Well, you have 22 other trades. If you make $3 on each of those, you've made what, $66? You've lost 30, you made 66 over the 52 at-bats you had. So I would venture to guess, Brenda, you're probably too focused on the one individual trade. Set up your trade, set up your risk reward. If it stops you out, let it go. Say, okay, I'm going to go back to the dugout, catch my breath, recoup mentally. I'm going to look for another opportunity and go out. And if this one works in my favor, you know, I'm going to step out of the dugout. When an opportunity presents itself, I'm going to get out of the dugout. I'm going to step into the box and I'm going to swing the bat. And if I strike out again, so be it. I might strike out 10 times in a row. But then you might get 4 at-bats or 4 base hits. Right? You might strike out 10 times in a row and then come up on an 11th time, you get a home run, maybe a grand slam. I might have one the other day, Cisco. I had puts on Cisco. Woo! Yes, it was yesterday, day before. Beautiful. Comes out with news, gaps down. Huge. I mean, that was a home run. They don't happen often, but it was nice. You're not alone, Brenda. I can tell you that. Somebody else just said the same thing recently. So, yeah, no, I mean, I understand. I've been there too. So you get low on funds, take some time off, and scrounge them up and put a little bit together and just take it easy, take it slow. So, I mean, I don't know what else to tell you. It is tough. I mean, trading is difficult. Anybody that tells you it's not, that says it's easy, is crazy. They've never done it, or they don't know what they're doing. It's not. This is one of the toughest things you will ever attempt to do, in my opinion. Very, very few people get there. I mean, again, go back to baseball. And I mean, how many people make it to the big leagues? What's 0.2% of kids? And unfortunately, there's a lot of people that don't get there because they do give up. Because they realize that, they don't have the mindset. I'd say work on your mindset mostly, Brenda. And that's where the things will change. And that's where things differentiate. And that's, we got deep into it last night, but the difference between the pro and the non-pro is that the pros bounce back from their failures or their shortcomings or, something happening to them that can work on your psyche, right? You go up and strike out. Okay. You have two choices. You can either beat yourself up and be like, I'm the worst player ever. I'm awful. I can't play baseball. I suck at it. Or you can say, you know what? That wasn't a bat. I came up. I looked at the situation. I analyzed it. I came up with my belief. I made a choice. I took action. I swung the bat and I struck out this time. That's all right. You know what? I have another bat coming up. I'm going to go back to the dugout, grab my mitt. I'm going to go out in the field, play defense. And the sooner you can bounce back from those, the failures, I don't really consider them failures. The pros don't consider an at-bat where they strike out a failure. They don't look back and say, I failed. I mean, maybe they do, but if they do, it's only with regard to that one at-bat. I didn't connect with the ball. Okay, so what? I don't need to connect with the ball every single time. I got 500-600 at-bats this season. All I need is one out of 4. And it helps my team win, whatever the case is, right? So it's really, this is about mindset and bouncing back from the challenges and the struggles and the failures. You're going to make mistakes. You're going to do stupid stuff. You're going to swing at a pitch that you probably shouldn't have swung at. And the quicker you bounce back from those, whether it's a mistake or it just happened, I just got stopped out on a trade right as we started. Cost me $300 or something like that. I've been hanging on for 2 hours. It's like, okay. And actually now it's setting up for a bullish trade. I'm like, I've got another one I'm in right now. I'm waiting on too. And if it moves, then I'll make up about half that. But it's just a law of averages, right? I got stopped out on one and I have another one going that might pay off. And if it does pay off, then it'll mitigate some of my losses. If it doesn't, I get stopped out on that. It's going to be, I think that was only got like $100 of risk or something like that. So it's not even a big risk. So you've got to, I'm not sure how you can do it or what you need to do, but it sounds like you need to shift your mindset into a bigger picture and just let things play out. Just find them. And I mean, if you don't have any cash, then obviously that's a problem. But if you have a little bit to play with, then you can do it. It is more challenging with less capital. There's no doubt. But the biggest thing isn't capital. It's mindset. That's most likely, and that's where most people fall short. And that is the most difficult part, is bouncing back from those things. And I beat myself up too. I mean, you're going to do it. It's just human nature. The key is to bouncing back from it quickly. Makes sense? So, let's do this. Where did it go? I think I had this up somewhere. Oh, it's in there. I got to get rid of that. Whoops. Let's get rid of that. Well, there's forgot that was there. Here's what we're going to do. We're going to play a little bit. And I did this a while back, and it was actually kind of fun. I don't want that thing. I can't stand that. I don't know why these guys do that. They make it so weird. Let's see if I can get another one. So, and I'm going to show, well, this is where, actually, we'll just do it here. We'll just do this real quick. Some of you probably remember it. I can't type. There we go. So you get a coin flipper online, right? So here's what we're going to do is, and this is going to show you, if you haven't seen this, risk reward is huge. It will, and this is why I talk about it so much, is because it will help shift your mindset. It should. And that's why I like talking about, you're welcome, Brenda, looking at the bigger picture and going, okay, I've got a whole season here and I've got this many at bats. I don't need to win on every single one. Right. So these are, and these are there from last time we did it, but it really doesn't matter. Right? The point is to see the example. So these are trading candidates, right? You got entry. Here's a stop, the target, the entry, and then the downside risk. And this is a 3-to-1. You see 3-to-1 risk reward. So on this first trade here, right, we got $5 of potential risk, right? Let me grab that thing down here. Just so you can all, I'm going to draw on here. Whoa, that's big. It's too thick. Okay, so there's the downside, right? See that? And then here's the upside. We got 3 times as much. Not what I thought it was. How do I clear that? Where did it go? Clear all drawings. There we go. That's better. I need a pencil. So $5 of risk, $15 of upside. Right? That's 3 times as much. So clear that again and give me the, I don't want that on. Mouse, there we go. I don't remember what is going on here. How come this is filled in? I thought I just had this working. What is this? These have all got formulas in them. I don't understand why there's numbers in here. Risk reward. Okay, that's. Oh, okay. I remember now. Okay. Sorry. Refresh my memory. So I'm not even sure why these green sparks are there, but we're going to basically flip a coin. So heads will be win, tails will be loss. And what this will do is calculate out our percentage of wins. And it's a 50-50, right? We're flipping it. So if we flip it, heads is a win, tails is a loss. So there's heads. So on this one, we're going to take this line first. We're going to say that's a winner, which certainly helps to start out that way because, whoops. Right? You get in the stock, it hits the target. Great. We made $15, 15.24. Flip it again, flip 50, right? We don't know which way the stock's going. All right, we lost on this one. Okay, that's a good one to lose on. The downside was 26 cents. It's always good to win on the big ones, right? But this is the thing. You can see I'm just flipping the coin. I'm not doing anything. I don't know what's going to happen. Okay, here's one. That's not good. That's a lose. That's actually the biggest potential winner, and we just took a loss on it. 8.15. Right? You see, if you look down the column, right? So this is the second biggest winner is $15. This one we had $24 of potential out of these 10 on the list here. So there's 10 trades here. And that was the biggest loser, $8. So on the second biggest winner, we won. On the biggest loser, we lost on. We flipped the coin again. Again, it's just the law of averages, right? This is head, so that's a winner. So that's 393. We flip it again. Heads, there's another winner. Hey, 2 in a row. Sweet. 687. Oops. Down to that one. Flip the coin again. Tails, there's a loser. 168. We don't like being losers. But welcome to trading. Welcome to life. I mean, everything. You're gonna make money sometimes. You're gonna lose money sometimes. It's never a straight line, right? Heads, another winner, 2 in a row. 732. Whoops. Gotta be in the right spot. I have a feeling tails is coming, but who knows? Maybe win 3 in a row. Another heads. Holy cow, this was going to be a huge because that's 3 big winners right there. But you know what? This is also reality. This is what happens. I mean, just by Cisco trade. Go look at the Cisco chart. You'll see it. I mean, it gapped down like 6 points. Not a huge trade, but I mean, it wasn't big dollars, but it was a double overnight, basically. Tails, so that one's a loser, 2.24. So here's the reality of it is you've got out of 1, 2, 3, 4, 5, 6. Okay. So we won on 6 and lost on 4. $52 of profits, $12 of losses for a net profit of $40. That's just random. And you know what? Just for fun, I'm going to do this again. Just for the heck of it. We'll do it real quick. Heads, that's a winner again on the first one. Again, I mean, it's 50-50. Watch, we'll win on the big one too. This will be tails. Oh, heads again. Ooh, yay, 78 cents. That's the smallest one there is. We'll go really quick. Tails. Uh-oh. There it is again. We lost on that one again. The big one. It's like trading NVIDIA versus trading Cisco. I mean, it's just is what it is. But and frankly, there was this winner 687. I gotta say, years and years ago, there was. I'll finish with that, Brenda. Heads, another winner. I gotta click over there. 5.04. I'll never forget. Some guy developed a. It's coming up a lot of heads. He developed a tool that I can't remember what it was exactly. All you do was it was based on this, and I think that's where it kind of sunk in. It was probably 04, 05, really sunk in how important risk reward was for me. Because it was like this: you put in your risk reward and this and that, and it didn't flip a coin; it just randomly gave you a result. Said, "Here's my target, here's my stop, and here's my entry point." And you just hit go, and it just randomly picked which one it was going to hit. And if you did it over time, it kept data, kind of like this is, but just more sophisticated. And it was like, it kind of solidified and made me realize that technical analysis, while it's important, it's not the most important. Most important thing is having the odds on your side and keeping your head straight. Those are the two things. If you're going to focus on anything, do that. I mean, here we are again. This time we got 7 actually, which is unusual, but so we had 7 and 6. It's 13 out of 20. That's higher than normal, but you know, if we did it again, it'd probably come up less tails. So either way, I mean, you can see realistically. I was hoping, because I know last time we did this, we only had, I think, 35 or 40% were winners, and we were still profitable. So you can go do this. I mean, just go punch some numbers in, go look at charts, and go grab a coin flipper and do it. Do it 50 times and see what happens. And this is random stuff right here. So it is certainly interesting when you go and do it a lot. All right. Any questions on anything? Anything there? Or we want to just go play on the charts? How do you get the coin flipper? It's really hard. Google it. Literally just Google coin flipper. That's all I did. Yeah, see? Just go to Google, hit coin flipper, and they have one right there on top. There's a bunch of other ones too. There's random.org, coin flip. There's a ton of them out there. So yeah, I'd look for it too. I was like, oh, they're everywhere. The US Mint has one. It's for kids, right? There's different games on here, but yeah, it's mind-boggling. And that's where, like I said, I come full circle. It's like you go from really focused on, hyper-focused on every single trade. And I got to make this, I got to do this, I got to do that. And it's like, if you look at it and you amortize it over a series of trades and you realize you don't have to be right that often and you'll still be fine, then all of a sudden your mind starts to go, okay, I'm not going to worry about it. Take whatever cash you have, say, okay, here's how much I have. If I risk X number of dollars per trade, I've got $1,000. I can risk $75 per trade. That gives me 10 or 12 different trades to do, right? And when I say risk, I don't mean a 75-cent option. I mean, you're buying a $3 option and you're stopping out at $2.25. You got to, I mean, there is always a chance that it gets worse. So you have to account for that a little bit, but, and look at it and go, okay, I've got $1,000. If I risk $75 per trade, then that gives me 12 or 13 trades in a row where I could lose before I'm wiped out. Approximately. You just call it 10. The odds of you losing on 10 trades in a row is slim. Because it is pretty much a 50-50 shot. Sure, you can analyze things. You can come up with, here's what it looks like it's going to do. And you can learn to see the picture and get a better idea and have a better belief of which way it may or may not go. based on what we see and what we know in the history of analysis, right? But when it comes down to it, it's nothing more than a flip of a coin. The analysis gives you an edge, right? You look at the chart, you say, okay, we got a head and shoulders. Obviously, this one didn't play out, but I'll give you one that did recently. Well, Las Vegas Sands and MGM. I still have the drawings on this. That's why I know it. But I mean, there's a beautiful, pretty much textbook head and shoulders, and it breaks down, dances around here a little bit, comes up and literally taps the neckline, and then just tanks from there. And this is where I scaled in. Each of those 4 lines is where I picked up a small position here, added to it here, and then it rallied up, tapped this, and as soon as it rolled over, I'm like, okay, that's even more confirmation. Now that we tapped it and then it rolled over, so I added more to it here. And actually, I think this was the exit. I think the last line. So got into it 3 different times, and I think maybe I scaled out a part of it here. But picked it up in 3 different chunks, and then it made this huge move. And you can see, I mean, this is the beauty of patterns. This is why I love them. Is there's a textbook head and shoulders, and it played out absolutely beautifully, and it came literally right to the target, and then it's bounced back in the last month and a half from that spot. I mean, it doesn't get really any prettier than that as far as I can tell. Now, does this happen every single time? No. Hence the reason that we use stops, right? Because sometimes it doesn't. Well, there's Wells Fargo, the one that was just on the screen. Here's an example of one that did not, right? You get into it, you know, it triggered the entry point here at 38.80, and it hit the stop a week later at 39.75. It didn't work out, right? We had a head and shoulders. It wasn't as pretty. But how much is that? $1. That's a little more than $1, a little less than $1, isn't it? It's a little less than $1. Just call it $1. We got Las Vegas Sands was almost $8. $8 of profit, right? From the entry to the, so with scaling in, actually, it would have been about $8. So you lose $1 over here and you make $8 over here. It doesn't take too many $8 winners to make up for those $1 losers, right? You can have 7 $1 losers and have one $8 winner, and you're still profitable. I mean, what's that, like 12%? It's crazy, right? So the key really is, again, it's to putting the odds on your side. It's going back to the 2 questions is, how do you put the odds on your side? And then how do you structure the trade as far as how many contracts you're doing, how much risk you're taking, so that you can stay in a place where you are calm, cool, and collected. Because when you get emotional, you make stupid decisions, right? We all do that. It's human nature. I did it yesterday. I got stopped out on one. It's like, I let fear get a hold of me, and I took it out. I said, well, I'll get back in if it turns around. And 15 minutes later, it bolted so fast, there was no way to get in. And I left a huge profit on the table. And then I was so focused on that I lost sight of another opportunity that was huge, and I completely missed it. So trading is really, it's all about keeping your mind straight and staying in that calm, cool, collected place. So, and once you get there and you don't make the decisions based on your emotion, that's when things will start to turn around. So again, that's what I would suggest, Brenda, is going through and say, okay, how much capital do you have? How much can you risk on each trade? And have a series of losers and not blow up your account, right? It's about capital preservation. That's the big thing, because you're going to have these ones like this. You're going to have the Las Vegas Sands that work out beautifully. You make a huge profit, but you've got to stay alive long enough to be able to take advantage of them, right? That's one of the keys. Get rid of those, or we're going to start from scratch. So Qs and spiders. This is, well, interestingly enough, and I've seen this a lot. It's not quite a broadening pattern yet, but it's pretty darn close. If it breaks north from here, even just a little bit, then we have a broadening pattern. Which some of you are like, what's a broadening pattern? What does it mean? Well, a broadening pattern is a megaphone, some people call it. It's an indication of increased volatility, which, especially when it comes at the top of a chart after a long bull run, it's usually an indication that the run is over. And even though the Qs hasn't done this yet, there are lots and lots and lots of stocks. I just got rid of that watch list yesterday. There's probably, last week when I went through my charts, because on the weekly whispers, I go through about 300 charts every week. looking for patterns. And so I see a lot of patterns, and usually you can find one pattern that's really prominent. Looking over 300, 350 charts, and I'm just flipping through them, right? Usually you see one pattern that shows up a lot, and the broadening pattern is the most common one that I'm seeing right now with a lot of stocks. I think there was 20 last week that all were in broadening patterns. This one hasn't yet. The Qs hasn't formed a broadening pattern yet, and doesn't mean that it's gonna top out. Not necessarily. Obviously, you see Wells Fargo, that pattern didn't play out. So sometimes they do, sometimes they don't. But it's weekly. Well, it basically means, let me see if I can find one in, I don't know if I have any in here or not, but it essentially increases it's an indication. There's one right there. Amazon. It's an it's an indication of increased volatility, right? Let me draw these lines on here real quick. And I go through all this stuff in Patterns in Flash. So if you haven't had Patterns in Flash, then go get it. If you don't remember, go get it again. So you can see there, right? We've got kind of the megaphone broadening. So the volatility is getting higher, right? We get this swing, which is not that big. It's pretty normal. Then it comes down a little bit, rallies back up here, makes a new high, and then it gets hammered down here, makes a new low, right? So we get higher highs and lower lows, which is not an uptrend. And then it drops down here even more, and then it swings all the way back up and makes another new high. So the swings are getting bigger and more wild and more insane, right? So the bulls and bears are the tug of war is getting bigger and bigger, right? They're at the match, and you got the bulls on one side, the bears on the other, and the bulls pull, and the bears about to fall in the pit. And then all of a sudden the bears come back and woo, and pull, and almost the bulls. A complete reversal, right? So it was just like back and forth a little bit. Then they pull this, then they pull this, and then all of a sudden one's, you know what I mean? So yeah, it's just an increase that the bulls and bears are getting more and more intense in their pulls back and forth between the pit. And the question is, who's going to fall in eventually? Generally speaking, it's an indication, like I said, it's an indication of higher volatility. When volatility increases, that's a lot of times the end of a run. How long it may take to play out, I mean, it could be weeks, it could be months. We don't know, right? That's the part that's always hard to figure out, is you don't know. And they're not really easy to trade off of, right? Because if you look at this, I mean, you've got this lower line, because usually I'm looking for breakouts, looking to trade the breakout of a pattern, right? Well, this line is drifting lower. So if Amazon drops off from here and I want it to break this lower line, it's got to get down to like 110, 115. It's fallen so far by then that there's no trade left. Could you trade it off of this, upper line? Possibly, but in reality, you have higher highs. So if you're trading bearish when you got higher highs, even though you have lower lows, if you're trading bearish, you're trading to a certain degree against the trend. It would be high risk. It's something that I'm not opposed to, but I wouldn't take a big position. And this is the thing when you have, and getting back to the risk reward, and you see the trading plan in place, right? Yeah, Bonnie, broadening pattern. Some people call it a megaphone because it looks like a megaphone. Whatever you want to call it, doesn't really matter. But what's interesting is you got this big bearish engulfing pattern right at the upper line, right? It sold off a little bit. And here's my risk reward. My plan on Amazon is to get in, if it drops off from here, to get in about 138. I might nibble on it here if it breaks below the 142 level, pick up a small position, maybe one or two contracts, and maybe add to it. If it continues to fall, add one or two more, then maybe go whole hog here. If it looks good, if the action's going well and things look like they're more and more bearish, then maybe pick up a full 10 or 20 contracts here. Potential is about $17. And we've got about a little more than $4 of risk. That's if you wait to get in here, right? So if you just get in at the basically 138 level, you got $4 of risk. If you nibble on it here, maybe nibble on it one more time here, and then you get full in here, you're probably gonna have about $3 of risk. All right, Kevin, see you. Have a good Thanksgiving. I know I'm supposed to be running too. I'll do that. So, because the riding pattern, Brenda. So, I mean, that's essentially what I do. That's where, especially when you're trading the bigger stocks like this, because if it comes down here to say 141, let's say I pick up, two contracts there. Well, my stop's at 143.50. I see you, Trip. You too. You've got $2 of risk, not $5 or $6 or $4 here. You only have two, and you've only got two contracts. So you don't have a lot of risk on the line, right? So if it turns around and stops you out, it didn't cost you a lot. If it keeps going, then you're already a little bit ahead of the game. So now you pick up 2 more. Okay, if it stops you out of those 4, then okay, it still didn't cost you a ton. It's a little bit more, but you have twice as much leverage now. So if it does continue to fall, and then you go whole hog here, it's like, hey, and realistically, what you could do, and this is what I do a lot, especially on day trades, short-term, really short-term trades. If I pick up 2 here and 2 more, and then say I add, go whole hog here, go all 10 here, whatever the number is you normally do, I might put a sell order, maybe even before that hits. I might actually sell a couple of them, depending on if there's enough volatility and there's enough profit there to make it make sense. I might pull 2 of them out here and take a profit on it. I might go 2 here, sell 2 here, and then have an order out here for 8. So I'm getting a full 10 when I get down here, but I've already banked a little bit of profit on a piece of it. You see, there's so many different ways to do it. And the main thing is not necessarily how you do it from all the little nitpicky technical things, but how do you do it for yourself so you can keep yourself in that calm, cool, collected place? Because I mean, if you get into Amazon here at 141, you got $2.50 of risk. How bad is that going to affect your account? I mean, it all depends on how much you're working with, right? But you look at that, and now you can look at numbers and say, okay, I've only got $200 at risk. I can handle that. I don't have 2,000. It's only 200. No big deal. So hopefully you see that, but there's the cues. I mean, as far as going back to this, Brenda, real quick, and then we'll touch on target, and then we got to call it a day. We're definitely at this resistance, and if it breaks above there, then I mean, we're looking at an all-time high up there at what, 405, 404, something like that, which to me kind of boggles my mind because I don't think the economy is as good as people want to believe it is, but I'm very bearish, as most of you know. So and this run is so far so fast, and the CPI number was not even that great. I mean, it's still, and the market, this is overdone. As far as I'm concerned, this is overdone. But that doesn't mean it can't keep going, right? The market can stay irrational for a long time. There's that old saying that says the market can stay irrational longer than you can stay liquid. So we got to believe what it gives us in the moment and work with it. So it's frustrating sometimes because right here, everything was beautiful. I was killing it. And then all of a sudden it turned and, get stopped out. You give a bunch of your profits back and it's irritating. And now I'm just got to sit and wait for another bear opportunity because I don't see any bullishness left in this run. It's too far too fast. So one more real quick and then we got to call it. We'll look at target real fast. Spiders are going to look the same basically. I mean, it's a very similar picture. So the gap up that's based on earnings. It looks like. If it's based on earnings, I mean, there's not much you can do about that. Obviously, they came out and said something positive, which, I mean, you say how much lower can they go? Well, obviously they can go way down here, but I mean, they're already at 100 from 250 a year ago? Yeah, 10, 21, I guess 2 years ago. Yeah, November of 21, they were at 250. Beautiful double top, right? But we've come back up. There's what looks like a pretty solid, yeah, that's a pretty solid level there, about 130. That's a weekly chart. So there is heavy resistance right there. Maybe even slide that up just a tad, but yeah, right there's that's about right. About 133. So yeah, will the momentum continue? Maybe not. This looks overblown to me, probably too. But then again, it depends on what they said with their earnings call, right? So sometimes you got to dig into it a little bit. I personally would just wait on this to see if any other pattern develops. If it comes up and it hits this 33, kind of like it did here, right? It came up, and bounced, hits it. This is the bulls completely failing. I mean, they busted through it here, but then the bears the next day came back and said, right? It's a tug of war back and forth. And the bulls are trying to get it above that 133, and they just can't. I mean, they did for one day. Then here's 1, 2, there's 2, 3, 4, 5. I mean, you got 7, 8, 10, 12 attempts for the bulls to get it above 133, and they couldn't. So that's a pretty big clue that, yeah, the bulls are not winning here. And sure enough, I mean, it dropped there from 133, took about 6 weeks or so, but it dropped all the way to 105. The question becomes, at what point do you pull the trigger on this? And that's what's hard, is we don't know. You have a bunch of these hits, and right here would have been a decent spot. You see all the resistance that it's hitting. It fails and fails and fails. And here again, it stayed above it for a day, but then the next day it failed big time. So you might get into it and hold for 3 or 4 weeks here before it makes a move, and then it doesn't really move that fast. It just kind of So, but if it throws any kind of bearish signal on it or up in this area, so are you serious, Bonnie? That's exactly why Target went from 250 to 105. All these companies that are going woke and doing all this stupid stuff, in my opinion, they're getting destroyed because the general population doesn't like it. They don't want it. Okay. You're entitled to your belief. You can have your stuff, but don't shove it down my throat. I don't think anybody wants other people's beliefs. You have your belief. I respect it, but don't force it on me. I think most people feel that way. They don't want to have things forced on them. And what you do in your own life, I don't care about, but don't impose your beliefs on me. That's most people can't stand that. So anyway, that's all I'll say on that. I would venture you're probably do okay, Bonnie, but I don't know. It's a flip of a coin, right? Hopefully you have a stop. Hopefully you're in a place where it's, you got your risk managed to where you're not freaking out. You can stay calm, cool, collected. So, Gene, real quick. Oh yeah. That's no surprise. I mean, that's why Disney's getting crushed too. Disney's getting destroyed because of the same thing. And my cousin actually took his son there just recently, like 3 months ago, and he sent me a text of one of the fairy princesses had a mustache. It was a dude. And he's like, and he flat out said, he texted me, he goes, I'm never taking my son back there again. He won't take him to Disney. I know. I mean, I hear about this stuff on the news, but then my cousin literally sends me a picture standing there at Disneyland with a fairy princess that's a dude with a mustache. And it just blew my mind. I'm like, I've heard about it, but I mean, now obviously it's real. I know it's real, but now here's my cousin sending a text just like, and again, just anyway, y'all have your own opinions on it. I'm sure whatever it is, but Gene, real quick, what is, that is true. You got to find the comedy in it, right? I do the same thing. You talk about this down here, right, Gene? The up close. I think that just has to do with the coloring. I don't remember what it is actually. Let's see. Real quick, and then Leah, sorry. It has something to do with close is greater than close from yesterday. Okay, so that's what it is. So if the close is up, then it will highlight the bar green, right? So close, you see, I don't know if you can see that right there. It says close greater than or equal to the close of 1, which is yesterday. So in other words, this bar right here that's green, that big tall one, the price closed higher that day than it did the day before. So it was an up day, if you will, right? So let me see if I can get a... Okay, so the day before that, I missed it by 1, but you can see this candle right here, we closed higher than the previous day, so it highlights the candlestick green. So that way you know that it was higher. Does that make sense? Not a huge ordeal. Some people don't do that. It's been like that for years for me, so I just leave it. But then if it was, like I said, if it was an up day, and it's not very often that they're not. Sometimes you get a red day where it was, it's the opposite, just goofy, but it's not necessary. The main thing I'm looking at is how much volume was there. The red and green really doesn't mean a lot to me. So clear as mud. All right, I'm gonna shut up before Lee starts yelling at me. So, all right, thanks for letting me ramble a little bit too long. But y'all have a wonderful Thanksgiving. Yeah, exactly, Gene. So thank you. I appreciate that compliment. So have a great day, great weekend, and we'll see you next time. All right, y'all take care. God bless. Bye-bye.